What's going on, everyone? Welcome back to the Capitalized Podcast. I'm Chris Cascella, and as always, this episode is brought to you by our private lending company, Sharper Capital Partners. If you want to learn more about how Sharper Capital can help you build your real estate investing business, you can check us out at sharpercapital.com. I'm here today with Ian Cruz, who is the founder of Elev8 Capital, a real estate investment firm focused on apartment investing in Cincinnati, Ohio. Ian, thanks a lot for being here today.
Yeah, thank you for having me, Chris.
Absolutely. I'm excited. And before we talk about your background, can you give us a quick overview of what your real estate portfolio looks like right now?
Yeah, so I primarily invest in multifamily properties both across the Bay Area and Cincinnati, Ohio. So the Bay Area, California, which is in my backyard, and Cincinnati, Ohio. I have a portfolio of 32 doors in that smaller multifamily space. And I'm also a co-GP on some larger projects as well in the large multifamily space.
Awesome. And I've gotten to know you as a real estate investor specifically, but there's a lot more to you than that. So for people who haven't met you, what does your professional background look like leading up to this point?
Yeah, so I have my CPA by day. I work as a manager of finance at a venture capital firm. So it is an investment firm that focuses on a different asset class, which is broadly tech startups, right? A number of interesting companies that we funded, and more relatable to you guys would be like Roofstock or Fly Homes, companies in the prop tech space, but it is broadly tech. We've touched a number of different areas. So in terms of my background, I worked at a public accounting firm. I did 2 busy seasons. I worked at PwC and got my CPA, and then was auditing Sequoia Capital, which is arguably the biggest VC. And from there, took a jump over to the current VC that I've been at for the past decade. Separately, I invest in real estate because, like I say, real estate is a little bit more accessible. I think I started just in terms of from a personal finance standpoint, just, buying a duplex and house hacking and things like that, and also helping my mom with some investment properties. And it is something that I started investing in and slowly started scaling over time. And then outside of my W-2 career, I also, I basically caught the bug with real estate investing. It starts with just trying to find an affordable way to own property in the Bay Area. And then after a while, it started to actually getting to know folks such as you and other people at meetups and building a portfolio.
So is that how it started for you? Was it being in the Bay Area and just trying to make real estate more accessible for you and home ownership more accessible for you? And is that how you came across the idea of maybe house hacking, or was it something a little bit more than that? You mentioned the personal finance journey and obviously the wealth building aspect, but what was it for you specifically working in venture capital that made you say, hey, maybe I'll try on the side investing in real estate as well?
Yeah, so this is beyond even my career. I mean, these are things, we grew up through 2008, probably a little bit. I was not investing in 2008, but you saw what happened, and people were impacted by that. My mom, my parents are divorced. My mom is a single mom, and she is very entrepreneurial. She owns her own yoga studio. She retired from her tech job, what, some folks that are traditional would say a little bit too early to own her own yoga studio. And she made some investments. If you're investing, period, you're going to end up okay. But there were a lot of mistakes, especially around that time frame, that stuck with me in my mind. Read a lot of books. I think my mom is she's a bigger person and very very forgiving, and you have to be able to have thick skin and move on from mistakes to be able to just keep on making moves. But there were things that were in my mind, like, how did this happen? I started talking to an attorney, like, what happened during this time? And there were a lot of things that just stuck in my head, right? And I really went down a number of rabbit holes as it related to investing, even when I was young, but didn't have the capital to deploy. From there, like you said, the Bay Area is expensive. I mean, the first thing I did, even before getting a duplex, we bought a condo, and we bought one right by eBay. And we rented out a room to a furnished room to a travel nurse. But when it's within your house, it's way easier than furnished housing separately, right? Because we already have the Wi-Fi, we have the living room. The living room is going to be set up regardless, dining room, all that stuff. So literally just adding a bed and a work desk and the things that they need. But the house is furnished basically, so it doesn't feel like a whole nother job. And that was kind of the introduction to it, just to make our our living expense more reasonable. It's such a big jump between owning and renting in the Bay Area that you're just trying to make it, when you're so used to paying a certain amount as a renter, you're just trying to make it more palatable, right? So one thing led to the next, and as it relates to my career, as it relates to venture capital, or even just accounting and finance in general, I always say that I got interested in house hacking or real estate investing because everything seemed like a math problem to me. But what's kept me, it just seemed like, we're going to talk about underwriting, I'm sure. It just seemed like I could look at these spreadsheets and determine if something is a good deal or not. But that's really just only the starting point when you screen a deal. I mean, you actually there's a lot that you need to do. It's not just how the deal pencils out, it's who how do you handle different situations. And I think that's actually been the spark that's kept me doing it and acquiring more properties, because you have to put on these different hats. You have to network with people such as yourself, Chris, or other people that are, all the people in the real estate space that you need to be connected with. And it really is a team sport. And we're, through all this real estate investing, I've used a different side of my brain than just kind of that backwards accounting looking mindset, right? So I think that's what's really pushed me to continue to grow as an investor.
And so just thinking through that, I mean, it sounds like your first deal, if I'm getting this correct, it was you and your mom, you bought a condo near eBay, and you rented that one out and lived in it, but you rented it out to a travel nurse while you were there?
Yeah. So that was just me, and
Okay.
I bought the condo. I helped my mom with some other stuff. I helped her 1031 a home into an apartment complex, which we added an ADU to. So that was a really cool learning experience. But I guess technically my first experience was a condo, which, house hacking always seems the least intimidating, right? Because you're just trying to buy your own home. So
Right.
yeah.
Yeah, and that's a great way to do it. I mean, by house hacking and renting to travel nurses, that's amazing. Can you touch on just real quick, Ian, for people who might not know, because it's not as common here as it is in California, but what is an ADU and what kind of role does that play in your investing in California?
Yeah, that's a great question. It's definitely not as popular in Cincinnati. Me having my California background, I actually scour to see if there's legislation surrounding it in Cincinnati. I know if you look through, for example, the Norwood, because I invest in Norwood, their council meetings, they actually talk about it a decent amount. So they're trying to figure out how they want to treat ADUs, but they're not as common, right? So ADU stands for accessory dwelling unit. It can either be attached or detached from the property. So what a lot of folks do, since housing is so expensive in the Bay Area, they'll buy a property with a big enough lot. And I mean, the lot sizes are typically much smaller here than what you're going to get in the Midwest, but it's, you want to make sure it's about 7,000 square feet or enough to be able to add a house that meets the requirements of how far away it is from the main property, from the lot lines, and stuff like that. And it's a good source of additional income, and they're really trying to encourage it. So there's also SB 9 and some legislation trying to encourage people to build those ADUs to solve the housing crisis. And you can subdivide the lot, right? So you can actually, I think it's a good play over in the Bay Area to buy a big enough lot and add ADUs, maybe even multiple, and subdivide and sell off, the ADU or the property itself. So that seems to be one of the biggest plays in terms of California investing, adding ADUs to a property. So or converting your garage into an ADU, it's a big deal.
Okay. Yeah, that's really good to know, and I think it's helpful. And something like that can have such a significant impact on the viability of a deal. So I think you mentioned that you've done a deal with an ADU. Can you kind of walk through that and what the numbers looked like with and without the ADU and how it impacted the returns that you were able to get?
Yeah. Happy to walk through it. I've done a whole podcast on this one, if I'm allowed to refer to that. But
Absolutely.
so one thing that's very unique about this transaction is that we did it through a 1031 exchange, and people don't know much about build to suit exchanges, which basically allow you to withhold funds from your relinquished property, from the proceeds of your relinquished property, to make improvements to your replacement property. right? So that's quite unique. But the thing that's very complicated about it is that it needs to be closed within 180 days, the same timeline. So that means all the improvements need to be done within that time frame, which is tough with permitting. If you're adding a whole ADU, that's very different from holding back funds to make, to do a rehab. So we had to go the prefab route, which is considerably more expensive than doing a ground up ADU. So prefab is pretty quick. They're really trying to encourage ADUs by any means, but in terms of getting the permitting, since the prefab, some of those plans are already approved. In San Jose, it's weekly. I did it in Santa Clara, so it took a little bit longer, but every week you submit, you're going to get it approved. They already have these ADUs ready to go. They can drop it off and add it to your property that way. So to share more about the transaction, it was from a single family home into a 5-unit apartment complex that we were adding a ADU to. So the single family home, this is going to sound very expensive, and it was kind of a standard 2,100 square foot 4-bed 2-bath home, but it sold for 2.4 million. Mind you, in May 2024, the median home price in Santa Clara County just crossed 2 million. So that is just, Bay Area housing for you. That is a house that was basically just breaking even as a rental, and it was sitting in a good school district. So my mom held on to it. That's where I used to walk to high school from that house
Mm.
in a decently, probably 8 out of 10, high school, pretty good high school. So that's where the value comes from. And that's where the stability and the tenants come from, because they just want their kids to go K through 12. We figured it was a good time for a 1031 exchange. And we did this in April or May 2022. So if you remember that time frame, that's when interest rates were going from like 2.5 or 3% to like, when they crossed 5, everyone was freaking out. Now everyone would kill for 5, but back then everyone was like, it definitely was the first time that rates had risen that sharply, and there was definitely a lull. So I'd say we got our last window for like getting a good a good sale price on a property. But I was like hoping the market would turn and kind of to be on the right end of both sides of things, but it takes a while for the market to actually turn. So we probably, you're under that 1031 time frame, and definitely prices have gone down since then, but we definitely won on the sell side. We definitely overpaid on the buy side. So what we did was we bought. I wanted to minimize the leverage to increase the cash flow in the Bay in property. So there was a decent amount of equity, and then I wanted to add the ADU. So we didn't scale up. Basically, we didn't sell for 2.4 and buy a $4 or $5 million property. We actually technically scaled down without the ADU. We bought a 5-unit for $2 million. There were 5 1-bedrooms. Each of the 1-bedrooms was getting about 2,200 per unit, and those were all subsidized. There's a good housing program. They're not Section 8, it's Abode, which they specialize in veterans and formerly homeless. So it's a good mission, good program. And yeah, so we bought that property with the 1031 proceeds, and then used the remainder, which ended up being about, after everything, any customizations and all that stuff, it ended up being about $320K for the 1-bed ADU. And we put it on the property as well. So that one is also being rented out to, right now it's corporate housing. There's a construction company that's housing one of their contractors in that unit. And then the other 5 are still Abode tenants. So that's been running very, very smoothly. And that was our entry point to the ADU and kind of multifamily space.
Yeah. Wow, that's really interesting. And what does the financing look like on your 5-unit? And when you add the ADU, does it make a difference on your long-term financing? Or if you were to add it before if you were to buy a property with, let's say, 5 apartment buildings and an ADU on it, in your experience, are lenders sensitive to that? Or will they look at it like a 6-unit, or what does it look like?
So in terms, so I'll just start at the very high level, right, to make sure our listeners understand this piece. But anything 5 units plus is commercial. So those are lent based on the strength of the property and not the borrower him or herself, right? So it needs to maintain a debt service coverage ratio above 1.25x, and it needs to meet these certain requirements to be able to lend on the property. The loan on that we needed for this property was not very much, because basically proceeds from the sale were about 1.5 million. So if we were buying something for 2 million, that's only a 500K loan, which is a very small commercial loan. Even when you're dealing in Ohio, usually commercial loans, they like to see it being over 1 million. So with the ADU, we basically lent the full like 800. So well, basically we only took 1.2 million that went towards the down payment, and we withheld 300. So you need an extra 300 on the loan. So it's about an 800K loan on the property. But it was so simple, honestly, in terms of like clearing DSCR, that we didn't need to underwrite with projected pro forma rents from the ADU, which I'm sure if it was tighter and we were using a higher LTV, that would be a little tricky. And we'd be going back and forth and saying, oh, we can get X amount for this. It was like, assume it's not there. Like, we can still qualify for an 800K loan. So that was pretty much what happened. Does that make sense?
Yeah, and you touched on the exact reason why I asked. I mean, even in Cincinnati, Ohio, a lot of commercial lenders have that minimum of $1 million, and they don't like to touch it if it's below that. And there are some DSCR lenders who will lend on, that like 5 to 10 units. Sometimes it's like the $500,000 to $1 million mark, but the financing is just trickier when we're talking about just above a 4 unit, but just under that $1 million threshold of maybe a 10 unit plus. So that's why I was curious, but that definitely shed some light. And one thing that we won't dive into here, Ian, is that holdback on the 1031. If you've done a whole podcast on that, we'll probably just point people in that direction if they can listen to it there, and we'll plug that down below in the description. But I appreciate you walking through that, because that definitely sheds a lot of light, especially for me and somebody who isn't in California, to understand the ADU and hasn't done 1031 exchanges. That's definitely helpful. So next thing I'm curious about is what your journey looked like investing in a couple of properties in California. What made you decide to venture from California out to Cincinnati, Ohio, to begin building a portfolio out here?
Yeah. So actually, simultaneously with that transaction, I was also buying a 6 unit in Cincinnati. And I was always eyeing, like I said, I caught the bug. I was doing all this research, and I was eyeing opportunities for my mom's 1031 exchange, sometimes knowing that to be safe, we may go down in price. So maybe there would be some surplus funds. What do you want to do with it? Do you want to add an ADU? Do you want to buy? I actually thought of the 6 unit for my mom's property, but instead I bought it. Basically bought it for myself instead, because I was like, okay, that's not really her thing. For her to own something in Santa Clara, great, but this is my baby. This is my project to take on. And I was going through all of the same education on the commercial space, and it was all happening all at once. During the same time frame, we were having somebody who mentored us in large apartment complexes. He's from the Bay Area. He actually walked, the Santa Clara 6 unit with us. So I basically just was learning so much about commercial and apartment investing, and also joining some of our local groups talking about that kind of stuff, that I knew that I wanted to dive into that in Ohio. And as we touched on earlier, this is something I didn't know. I didn't know how hard it was to get a small balance commercial loan. I thought, oh, this will be even better because I'm dabbling into a smaller, barely getting into the 5+ unit, right? So I'm like, oh, this should be the best, right? The least amount of headache. But getting that small balance commercial loan was very, very difficult. Also, being somebody who hadn't done commercial deals and being from out of state, it was around the time that things were getting a lot more strict. And Cincinnati and Ohio in general, they're more conservative with their lending, which is why, like in the large apartment space, things aren't facing as much distress as in other markets, right? So for me to find a loan was very difficult. I had to work with one broker couldn't deliver on anything. I had to work with another one. And I mean, sometimes the terms were only on 20-year amortizations, which was really tough. I'm like, that eats that's pretty tough, right? And they weren't doing, I mean, it's a 25-year amortization, but oftentimes we were basically getting turned down or getting really really bad terms or terms that made the deal difficult. So that was a process. That was a learning process for sure. And we moved forward with the 6 unit, and it ended up being a great property.
Were people were lenders mostly skeptical? Was it more the size or was it more the intangibles of you being out of state and your lack of experience? What was it that weighed most heavily, or was it all of them just, I guess, in
It's definitely
combination?
both. It's
Yeah.
definitely both. It's probably even more so the size of the loan. They didn't even have any offerings to anyone, it sounded like. But, and then me not knowing, I mean, we ultimately use SynFed. So SynFed, and they've pulled out of some of these loans now. But yes, I wouldn't have known to reach out to SynFed. I thought I called everybody, but I definitely wouldn't have known to reach out to SynFed without a broker. So that was tough. Everything that you scour on forums and stuff, I feel like I called all those numbers. I wasn't getting through to anybody. US Bank would have lended on it, but we requested 1 unit vacant, which hurt the DSCR, which was kind of like a bummer because I was like, but it worked out for sure.
Yeah. Yeah, and I think, you mentioned earlier in this conversation how you were looking at some of these deals early on in your career, just like math problems. But then I think this is a great example of how a lot of times, the DSCR, obviously, that's a math problem. But there are also a lot of other factors to consider, like whether or not somebody is local or not, what somebody's experience level is. And as a lender, we definitely consider those things. And so do some of the larger lenders, the commercial lenders. And then when you're underwriting a deal, which we'll talk about in just a little bit, those things are definitely important as well. But what was it? What was it? You have a little bit of a connection to Cincinnati, Ian. I know that not everybody knows that, but what was it about Cincy that made you interested in coming all the way out here to invest in real estate? Why didn't you just continue in Santa Clara or California in general?
Yeah, the Bay Area is great, but Cincinnati is definitely a market that I'm super interested in and have been investing in. So with the Bay Area, the play with some of this stuff is to hold on to it and let it appreciate, so you get that big nest egg to deploy for cash flow later, which is basically what my mom did. So holding on to real estate or using primary loans with the best terms and just buying and holding for a period of time, taking advantage of Prop 13, which locks in your property taxes at the current rate. That's very unique to California, right? Like some people have dirt cheap property taxes, which is crazy. So holding on to property, you're very much incentivized to hold on for a long time. Then you get a nest egg to invest. In terms of Cincinnati, I love the city for one. I go there, I travel out there quite a bit, and I always say that it's the most important to know the where you're investing. That way, you get a little bit of a competitive advantage of knowing, hey, street one is better than street two because in it, most people wouldn't know that, right? If you're only looking, just an outsider won't know that. So for me to have connections over in Cincinnati to start and have friends out there, have people that I could talk to was definitely a big thing. Some people also have the rule that you need to be able to have a direct flight somewhere that you want to invest, which there is now. There was a period of time where there wasn't, but there is a direct flight. But to me, it's also got to be a place that you don't feel miserable. Like, oh, I got to go to the middle of nowhere and spend 2 weeks out here handling this problem. You're going to burn out really, really quickly, right? So the funny story behind it is that I've been a diehard Bengals fan since 2003 and formed a fan club that got posted on Bengals.com. And a lot of people that moved to the Bay Area from Cincinnati found this bar that we used to meet at. And they would just, one of them has become invested in our North Side deal. So, we've talked about investments since then. But a lot of these people were folks that were from Ohio that moved here for tech jobs, and we bonded over the Bengals, right? So nothing about real estate for a long time, but as I started going here, doing more deals, I could ask questions. Some of these people I have mutuals with that are completely outside of real estate, which is nice because I mean there's work, but then also just getting a character reference on people is good. And as I've started to, as I decided, hey, this is going to be my niche, this is going to be where I can operate, as opposed to me getting analysis paralysis debating between the three C's of Ohio, like it, the chances of me getting a better deal or being partnered with a higher quality of partner, which ultimately you need, it's going to be here. So That's the biggest thing. I think all of the Midwest is going to do well in the years to come. I always say that, and there are some people that I know that are so focused on making sure that they find the right place that they don't take action, or they take action in multiple areas and they actually aren't very specialized, or they don't have good systems in place when things happen because they're just doing stuff everywhere. And props to everyone who does do things in multiple markets, by the way. I mean, it's crazy to me, but people are very successful doing that, right? But for me, I've really made this my niche and focus.
So there's two things I want to get into, and we'll start with the network that you've built. So you're investing out of state. You have a very healthy network, at least it appears that way. And I've seen you a handful of times in Cincinnati, and it seems like you've made built some really good relationships, including this one. I'm very grateful to have met you and gotten to know you over the past, I think it's been just about a year now. So, how have you built your network in Cincinnati? How have you gone about getting to know the right people and building relationships that have helped serve you, not just personally, but also professionally as a real estate investor?
Yeah, and this is the stuff that the version of me that became an accountant would be surprised that I'm doing so much networking, right? That version of me fresh out of college did not like going to even like big four networking events. I dreaded it. But now just meeting people and talking about investing, it's been so instrumental in my own growth. So a lot of this stuff happened organically. Me being so scared of making any type of mistake on my on the transaction with my mom, thinking of that as her retirement, it gave me a different sense of ownership and accountability, which led me to join a bunch of groups to learn about real estate investing. So there are a number of different networks that I have been fortunate to be a part of, both in Cincinnati and outside of Cincinnati. And I've helped, for example, there's a startup called Fractional, and we know the founder quite well. Her name is Stella Hahn, and they help investors partner together to buy property. And what they do, like there are a number of startups that try to tackle this whole co-ownership model of real estate investing, but what they do and what they focus on is community. So within their website and their platform, they have all these communities which can be either public or private. Think like a Facebook group, and where people look at deals, share off market deals, and try to partner together, right? And they have some programs like an Elev8 accelerator, or accelerate. So they have like a cohort of tech individuals that want to learn about real estate investing, and they all get held accountable, right? And they find and close deals together. The tagline of the company is buying homes with your homies. So we've done
That's awesome.
some deals with them, but through that network, I started hosting. I host a Cincinnati fractional group, which is over 150 members now, and I started hosting a lot of underwriting calls. I think it's good to share what you're doing at all times, right? That's why people have podcasts and social media and things like that, and as just something that's really core to my personality is to share. Outside of all this real estate stuff, I also volunteer as a coach in boxing, and the phrase I always say is each one teach one. One of the highlights is when like some of the kids I coach go on to become coaches and help other people. So I think that's, I don't feel like this is some sort of transactional thing with when I host an underwriting call where I expect anything out of it, right? But I just continue to share, give, provide value, and host these calls, and eventually you start to get to know people, and things align, partnerships align, all that kind of stuff, right? So it's through hosting these calls, it's through putting together some presence on social media, which is actually how we met. And I'd say social media gave me quite a few really strong connections over the years, including partners, right? It's probably led to our Cincinnati investors field trip. It's probably led to my partnership with Slocum, definitely with Bulbul. That was somebody that we met through social media. And you saw my page, which is very Cincinnati focused, and you saw me commenting on a property that I was looking at, and you reached out, and we had a call, and it's been it's been good to know you ever since, right? And it's just, you never know how, I mean, it's such a small thing, and then such a coincidence basically, and you meet all of these great people that make creating that page so worth it, right?
Yeah. Yeah, and I think a through line for really a lot of what you're talking about right now has just been adding value. And I remember the first time I came across your page, it was somebody that I know very well. He's a local agent and investor here in Cincinnati. And I saw your comment below one of his Instagram posts, and I went to your page, and your page was actually relatively new at the time when I reached out. But it was just absolutely packed full of value. It was stuff that I, as an investor and as a lender, really, I mean, it's stuff that I wanted to know. It's stuff that I was not only interested in, but I felt like definitely added to my ability to invest in Cincinnati. I don't want to keep on saying added value to me because it doesn't actually, that term doesn't carry enough weight. I feel like it's so specific. You're talking about tax regulations, right? A big thing in Cincinnati is that a lot of properties just got reappraised, and they got reappraised at a much higher valuation. So people's property taxes went up significantly. And in an environment where rates are 7, 8%, there's not a ton of margin to begin with. Prices are high. Just, having your taxes go up is just icing on the cake there. But you posted recently about that. And so I say this because I think one thing that stood out to me, and I think probably a reason why you've been able to build such a great network, is really because you have added a ton of value. And I just want to take this moment to say that to you. And for anybody else who's listening, say that that's the best way, right? One thing that you just mentioned was giving without expectation. And that's really hard to do. It's really hard to go out there and just give with nothing, without getting anything in return for long periods of time. But I think you're a prime example of that paying off over the long run.
Yeah, I appreciate that.
Yeah, absolutely. Awesome. And so the next piece here, in addition to the networking, on the same in the same vein here, you host underwriting calls and you're talking about how you're looking at deals. And that's also one of the things that comes up on your website, on Elev8's website, is conservative underwriting. So can you walk us through what your underwriting process looks like, how you stay conservative and keep emotion out of it? What does your underwriting process look like as an investor, especially as somebody who's looking in from out of state?
Yeah. So in terms of underwriting, I mean, you're basically verifying all the assumptions. I tell people not to trust the pro forma. I've seen all types of stuff on a pro forma, so just do your own underwriting of a property. Things may look good, but just assume a little bit worse. So a few things. I mean, two sides of the deal, right? Revenue, expenses, rent, and expenses. Rent is something that I think everyone intuitively knows how to audit. You can check Rentometer is my source of choice, but also checking Zillow to see what live listings there are. Your property manager will have some insights. If you've had to lease a property recently in that area, then you're going to know the market rent there. As far as tips that I can add or share is just to understand, I guess, the seasonality of rent over in Cincy. It's a little bit harder in those colder months, and also really understanding the floor plan, because sometimes some of these, like if you underwrite like a 3 bedroom or a 2 bedroom and then you actually see the floor plan and it's really funky, don't just say, hey, this is a 3 bedroom, this is what Rentometer says, right? I'd say, and then just be conservative. Don't just assume 99th percentile for rent, especially without the right amenities or right appliances, right? There's a certain level of finish that corresponds with a certain level of rent. On the expense side, and I'm going to talk about multifamily investing, your big ticket, and I guess it applies to all of them, but your expense ratios are going to be higher for multifamily investing. I always start with the big ticket items, which are your property tax, your insurance, capex, and property tax, insurance, property management fees. So those are going to be your big ones. Your property tax, a lot of people don't know how to calculate the property tax in Cincinnati. And sometimes they assume that it'll be the same. There are things that people can do to keep those property taxes lower, whether you buy a tax abated property or do an entity transfer in the larger multifamily space. Those are things that can be done, but you don't want to underwrite assuming property taxes are going to remain that way, remain at a low basis. You always want to bump it up. So the good resource I point to people for property taxes is like, I think it's on Bell something is a website, and I have it bookmarked, but actually recalculating at 80% the purchase price would be a solid assumption. just not assuming property taxes are going to remain low. They usually are about 20 to 25% of rent. So they do eat into that expense ratio quite a bit. With PM fees, assume depending on how many units you have, I mean, it's best to just underwrite with 10%. But one of the things that people don't include are all the commissions, the lease up fees, which could be a month's rent. Vacancy on the small properties are not necessarily just some clean 3%. I understand the math behind 3%, but it also just, that's assuming your average tenant stay is 36 months, is basically what 3% is. But realistically, when you're working with small numbers and things happen, that's going to be quite a bit higher, especially when you're stabilizing a property. Insurance, this is something I'm learning in the larger multifamily space, that some of these big players and big syndicators do get these much more preferential insurance rates than what I'm getting on a smaller, much older building, right? So I was always budgeting 450, even 500 at a door on the multifamily side for insurance. It can be lower. It's good to know whether you're, and I just posted a video on this. An insurance broker was arguing to take, I always get mixed up, ACV over RCV. I think most people go RCV, which is the higher one. That's basically the undepreciated, that's just cash to rebuild, replacement cost value, right? Versus
Right.
actual cash value, which takes into account depreciation. So his case was to go ACV because you don't, I mean, my primary RCV all day, right? But he was saying the depreciated value, you're going to just take that and buy a different property. So that was his take. Definitely, I know a lot of people that do RCV, but that, I'd say that's the more common and more recommended version, right? But as you do this, you guys should run quotes and see what these numbers really are. Insurance costs are definitely going up. So whatever, if you play this in a year, it may be different. Although there is some word that they're actually starting to stabilize in Florida, but overall, like, I guess a safe assumption for insurance is 450 a door. What other big ticket items are there? I mean, capex and repairs and maintenance about 5 to 10%. So if we're just looking at the numbers, the things that really eat into it right off the top, if property tax takes up 25% of your gross rent and property management takes up another 10%, you're at 35. It's very easy to get to a 50% expense ratio when you start adding insurance, repairs and maintenance, and stuff like that. So definitely when you see a pro forma that starts day one at 50%, that, or it starts below 50%, starts at like some 30% ratio, it's probably, your first year isn't actually going to look like that. I see OMs. I mean, if I'm selling a property, I'll underwrite it the same way the properties are underwritten to me. Like I see some of the OMs assume even self-management, right? And then they say it's a cap rate is 8 or 9%, and I don't see a property management fee on it. And that's not, I mean, you could put whatever you want on this marketing material. If you're selling to people from Cincinnati, they're going to look at it that way. But you have to compare apples to apples between, different properties. You can't say property A is better than property B because it has a higher expense, or it has a higher cap rate. But then you're like, hey, wait a second, like, look at this underwriting, that this one assumes self-management, this one doesn't, or this one didn't bump up property taxes while this one did, and that's stuff that it's just practice. You just start to be able to, it becomes a huge checklist in your head. Boom, 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 boom. Like, how do I look at all of these assumptions, right? What's your rent growth assumption? When you get into large multifamily, it gets, the models have so many more inputs, and then they become sensitive. It becomes this huge thing that gives you a lot of room to hide stuff, right? Like, you just tweak one input here or one input there, and you don't
Right.
notice. So it takes reps to kind of know these back of the envelope rules, and like check, compare all the way throughout the spreadsheet.
Yeah, and that's just chock full of super valuable information. And an underwriting podcast could go 2, 3, 4, 5 hours. So I would encourage people, if those underwriting calls that you do, Ian, are those available anywhere for people to see?
Message me is what I'd say. Schedule
Okay.
a Calendly and message me. These are sometimes live properties, so I don't want to share them until after they're done. But
Yeah.
yeah, and then I'll figure. I've underwritten different things, right, from the small to large multifamily. So I'd say message me. You can add my Calendly to the show notes as well.
Okay, cool. Yeah, we'll put that stuff down there. I still have a few other questions, but one thing we're doing at Sharper Capital is we're in the process of hiring a loan processor, and I've gone through this process of building out the loan origination process all the way from quoting to actually closing a loan. Grant has come in and been super helpful to have a fresh set of eyes. But one thing that we realized as we were going through this is that checklist of everything that needs to be done from the moment I talk to a client to the moment we get to the closing table, a lot of it lives in my head and I'm so
Yeah.
used to it. I can go through it, but it makes you so much more prone to mistakes. The reason I say that is because, I've looked at these big multifamily underwriting models and they are very complex. There's a lot of different inputs, and one input can have a significant impact on whether or not a deal looks good or whether or not it doesn't. And so I'm
Mhm.
a huge, huge proponent of checklists and physical checklists and taking it out of your head and putting it somewhere and going through the process. Now, it's probably more important when you're looking at a big multifamily deal like the ones that you're looking at, Ian. But I think it's
Mhm.
also very applicable to people who are doing 1 to 4 units. Even if you're just doing a single family home and you're flipping a property, I mean, how valuable would it be for you to have a checklist and say, hey, every single time I flip a property, this is everything that needs to be done the moment I close on it, the moment I go through, the moment I am going through the renovation, and then when I'm selling it, here's everything that needs to be done. And even before all of that, having an underwriting checklist to say, hey, here's everything I need to look for to make sure I'm not getting emotionally attached. I'm not overlooking one small thing, which could make a major difference. I think that's just a really important thing to mention. And I'm glad that you brought it up. And the other thing I will
Yeah.
say, oh, go ahead, Ian. Yeah, yeah.
Yeah, I was gonna say, you actually saying an actual checklist gave me an idea, because that checklist is in my head, and I've probably repeated myself with all these different bullet points number of times. So I should actually create that as a checklist. And I did all this talking. I didn't even talk about utilities, I realized, but whatever. We could skip all.
No, it's really
There's so many
hard.
things to talk
And
about. Yeah.
there's so many things, and that's why the call could go on forever. But I am a huge proponent of that. I'm not perfect, but I think it's something that's very valuable. And I'm really glad you talked about insurance too, because I think so many people are inclined to look at the insurance piece and say, how much is it going to cost? And then they kind of put the onus on their agent to say, hey, just give me a policy that makes sure I'm covered. But there's a lot of nuance to insurance, and there's a lot of different things that go into a policy that if you don't handle it the right way and make sure everything is accurate up front, could be a major problem once you go to file a claim. And
Mhm.
so, in order to avoid being surprised by that, I highly encourage everybody who is investing in real estate, no matter where you are across the country, to take the time to talk to an insurance agent, multiple insurance agents, because you're going to get different answers from different agents. People have different opinions. Some agents are able to offer different coverages than others. And so, I think taking the time to fully understand that, in addition to the importance of the underwriting piece and how much you're going to be paying per door or for a single family property, is also how covered am I actually? And
Yeah.
I think that's something that, that's the main point. So definitely not something you want to overlook.
Yeah.
To wrap up here, you have had some exciting things come your way as of late. I know that we can't get into too much detail, mostly because it's ongoing and it's a project that's local. So can you talk a little bit about what your most recent deal or venture looks like without getting into too much detail if you don't want to, but just kind of talk us through how this opportunity came about and what it actually looks like?
Yeah, so I'll actually share the last two deals that we've worked on to highlight the importance of partnerships and networking and meeting people. On the smaller multifamily side, we closed on an 8 unit with Slocum Reed of the Best Ever Network, and he is an incredible partner to have, owning his own property management company and complementary businesses. And after doing, a lot of things, I've learned just the value of having a good local partner on a deal, right? I've tried, you do see me come out quite often, but having strong partnerships, I mean, it helps a lot. On the larger multifamily side, we did co-GP with another group named Venture Real Estate Company. They have gone full cycle 28 times in Cincinnati with an average IRR of 38%. So they have a very strong track record and very strong reputation here. They never took on bridge debt, and they are in the midst. I mean, all of their deals are performing very well, to say the least. They're in the midst of some cash out refinances right now, and a lot of deals are requiring cash in refinances or capital calls right now. So they are just, I really, am fortunate to be partnered with them on the deal that we are. And they, not going to talk about the deal itself, but the partnership came about because I had the chance to meet Robbie and talk to him as an LP, because I do invest in this area passively as well. This isn't just about my own active portfolio, right? And we built a relationship over time, and like I said, I was very fortunate to have an opportunity when they didn't necessarily need co-GPs on their team to complete out the deal. And we did bring out, we came out and checked out the asset. We did also underwrite the deal and look at it, and I shared it with our group of investors to participate in the deal, which was definitely a very, very interesting process, right? Our first, we've raised capital on smaller JV deals, but it was our first raise on a large project of this scale.
Yeah, it's super exciting, and it is a large project. Again, I'm kind of being ambiguous and a little bit arbitrary here because I don't want to disclose anything I'm not supposed to, but that is really exciting, and I've enjoyed getting to know kind of some of the details about that, at least what you're able to share right now. Now that it might be beyond the scope of what a lot of our listeners are working on, but I think it's just another testament to the power of networking, the power of being able to deliver value for, an extended period of time without really asking for much in return, because then seemingly maybe out of the blue, you have an opportunity like this, which, far exceeds, I think, any deal that you've done in the past, at least from just the sheer number of units and dollar amount, right?
Yeah, that's very true. I think, something to take it full cycle. I mean, the reason why our base was so eager to invest in this deal is because we actually underwrote their deals that were owned by them in the past. We were already familiar with four of their deals in the past. So it was, and they know me as being somebody who was underwriting deals either for myself or just underwriting to share and practice with other people, that they know that I'm not chasing door count or anything like that. This is truly just a good opportunity, and to share this group that we've known on a different side of the table for a while. It was kind of like, wow, this is an awesome opportunity. It checks all the boxes that we know to check now. And yeah, it's a great learning experience. And like I said, being able to partner with a group like that, it helps a lot. It helps. Like I've learned so much just being partnered with them.
Yeah, it is a really, really impressive stat to know that they're doing cash out refinances right now and that they've never taken on bridge debt. Grant and I were in Dallas a couple of weeks ago, and we listened to a speaker who runs a $500 million fund. And he essentially does what Grant and I do with short term bridge financing it, but he just does it on a much larger scale with big commercial properties, including multifamily. And one of the things that he said that really stood out to me while he was just kind of giving his spiel was he's looking at about 100 to 150 deals a week that come across his desk. And
Wow.
I don't know if everybody can fully understand how many deals that is, but that's a ton. It means that that's a very busy space right now, and he's taking his pick on what kind of deals he wants. One of the big reasons for that is because in the commercial space, especially, a lot of these banks, even if the borrower is performing, they're just calling their capital because they need more cash on their books. They need to kind of restructure their balance sheet. So there's a lot going on in the commercial space. So to know that they're doing cash out refis and they've never taken on bridge debt is a testament to their underwriting and the way that they're running their business for sure. It sounds like they're a really solid group.
Yeah, that's interesting. You mentioned that they are trying to call their capital when they're performing. I mean, can you? How does that work?
Well, the loan is coming due. So I used the wrong
Okay.
phrase there, but let's say the loan is maturing in
Yeah.
2024. They're not extending. So they're not calling
Yeah.
it
Yeah.
early, but it's coming due. And they're just saying, I know you're performing, but we're not gonna extend because we need the capital back. And there's a
Yeah.
few reasons why that's the case, right? But
Mhm.
it's just an interesting time in commercial. So it just I think speaks to their ability to perform. So I think that's really interesting. And the last thing I want to ask you here, Ian, is you have a lot of exciting stuff going on, but where do you see yourself going in the future? What's your kind of ultimate goal if you do have one, or just directionally, where are you headed with real estate investing?
Yeah, we're growing our portfolio, but I'd say that's slow and steady. We're not rushing into deals that don't make sense. I think the partnership with venture is great to give our investor base a good return and to be invested in such a great project. Something that Robbie shared with me, and that I'm, you know, that I, that I did realize at the same time. When you partner with somebody, there is an opportunity cost as well. Like if I raise that same amount of money for a smaller project where I am the sole and only general partner, those kinds of deals can definitely be a lot more lucrative. But at the same time, deals don't pencil out right now for the most part from what I'm seeing. And I think our investor base had seen us struggle and not really come close on some of the large multifamily that we were offering on. So I think being able to align ourselves with a group and learn from a group that we did is just incredible. But it's not like we were just chasing door count and saying, "Hey, we want to just be a co-GP." We want it to be a lead sponsor of a deal that we can actively manage and bring on the right partnership group, both on my side, but also on the local side as well, to manage the asset. We're looking. Well, right now we're focused on more operational things than just acquiring. But we do see in 5 years for us to be able to scale into a larger portfolio without being like chasing door count, but knowing that these experiences will allow us to acquire good deals, right? That's, we're just going to stick with it, stick with our process of what we're doing right now, and see what comes.
That's great. Ian, you are an incredibly humble person. You do genuinely give a ton of value in every room that you're in. I'm glad that we crossed paths, and I'm glad that, you know, for one time, I actually am glad that I was scrolling social media and came across your account, because I value that our relationship that we've built, and I'm glad I've gotten to know you. So thank you so much for taking the time here. Before we go, where can people go to find you, and how can they connect with you?
Yeah, and I'll give one self plug as well. So my Instagram is Cincy Cash Flow. My LinkedIn, just by my name, Ian Cruz CPA. And I'm also hosting a field trip to Cincinnati in late August. Definitely looking forward to seeing you, Chris. We're bringing a group of 40 investors over to the market. We have a number of great speakers lined up. So if you're interested, information is going to be on my social media. And if you're local to the area, would love to meet you as well.
That's great. I'll go ahead and put a link to all of your social media down below in the description. I will also put a link to, what were we talking about earlier? I was going to link something down here.
Podcast,
That's
the
right. Your
1031
podcast talking
exchange.
about the 1031 exchange with the holdback. I'm going to put a link down there. And as always, I'll put a link down to Sharper Capital's website as well. So I appreciate everybody listening. Thank you for taking the time out of your day, and we'll see you in the next one.